Yen is still about monetary policy divergence. At the last meeting, the Bank of Japan made no surprises as policy bias remained status quo. Bank of Japan Governor Ueda sounded dovish in his comments, saying that uncertainties around salary and inflation are high, and therefore the goal of 2% inflation accompanied by wages gain has yet to come into sight. He also said that policymakers are patiently looking or continuing with monetary easing under the current framework. There is no hint that a BoJ shift is in the works as of now. This underscores how dovish the BoJ is, and policy divergence with the rest of the world should see yen underperform. Barring intervention surprises, we should expect dollar-yen to be driven by yield differentials, and the path of least resistance for dollar-yen is still to the upside amid a widening of the UST-JGB yield differentials. On that note, it is worthwhile to caution for the risk of leaning against the wind activities should the pace of dollar-yen's rise becomes one-sided and excessive. Beyond the near term, our house view still expects both the yield curve control, negative interest rate regimes to be removed over time, depending on how fast JGB yields and inflationary pressures and wage pressures rise over time and how sustained the rise is. We do note that inflationary pressures are broadening in Japan. Growth outlook is somewhat improving, and upward pressure on wage growth remains intact. The core inflation is now running at over 40-year high of 4.3%, and both nationwide and Tokyo CPIs show that price pressures are broadening. This reinforces our view for a BoJ shift at some point later this year or in early half of 2024. In the near term, dollar-yen could still trade higher, but into next year, we expect dollar-yen to trade lower on the back of a moderate to soft dollar profile as Fed tightening concludes, and that dollar can fall when Fed dovish pivot comes into play, and on expectations for a BoJ shift towards policy normalization amid higher inflationary and wage pressures in Japan. The renminbi has weakened by more than 5% since the start of the year, and it was largely driven by economic woes at home and persistent dollar strength. We believe quite a fair bit of bad news is already in the price of RMB. In response, policymakers have also stepped in with support measures that could potentially bear fruit over time. For instance, China had earlier announced support measures targeting real estate markets. Recently, China's CCTV also reported that China will continue to break down barriers to market access and increase policy support measures for private economy. China is also taking steps to ease strict capital control measures in Shanghai's free trade zone. Beijing is also proposing similar regulations which policymakers are seeking public feedback on. Tentatively, recent China economic data has shown some signs of improvement. The industrial production and retail sales rebounded in August. Exports and imports data saw its pace of deceleration slow in August. CPI returned to positive territory. PPI fell less than expected. The August credit data rebounded significantly from July numbers. China Index Academy also reported that existing home sales volume in Shenzhen, Beijing and Guangzhou rose. Potentially, more support measures such as rate cuts, real estate support could also be on the way. And if policymakers can address the confidence sentiment channels, then the renminbi weakness may moderate, especially when there's so much pessimism in the price. Meantime, we should expect China to continue with its strong fix to reinforce a consistent message that it will not tolerate excessive overshoot in its currency. We continue to monitor if these early signs of data improvement and PBOC warning can further translate into more meaningful recovery in renminbi. Ultimately, for RMB to stabilize fundamentally and recover would still require China economic activities to pick up, confidence to be repaired, and that is foreign inflows need to return, and for dollar to turn lower. The first two factors will require policymakers to urgently address economic issues, including its real estate sector, the LGFV debt, and shadow banking sector, and to swiftly implement policies. While the Aussie dollar is a highly sensitive currency to global growth cycles, Fed tightening, commodity demand, and the RMB. As such, it may still trade under pressure as US rates staying higher for longer poses risks to global growth and undermines sentiments. These will be the key drivers for now until US economic data starts to show some signs of softening, as that can lead to rates easing back and dollar trading softer. This can provide a breather for Aussie, but apart from paying attention to dollar trend, we also need to watch developments in the RMB space and China data. Lingering weakness in real estate sector and China growth are some factors weighing on Aussie, but with so much bad news in the price, we also keep a lookout if there is any turnaround in China data. Improvement in China data can somewhat partially mitigate against Aussie softness. So while the risk in the near term is skewed towards Aussie downside, we retain our medium-term view for Aussie to trade higher over time, on expectations that China growth should stabilize at some point, possibly warmer ties between Australia and China that can support investment and trade flows benefiting Aussie, and a more moderate to soft dollar profile as Fed nears end of tightening cycle and embark on rate cut cycle in 2024.